the valuations, in the private lending world are more based on the actual fundamentals of the actual underlying loan. And because they actually don't trade in a formal marketplace, they're not subject to the market sentiment pricing and the laws of supply, demand, things like that. It doesn't mean that if you have write downs on a loan that it's not going to be impacted in the net asset value and add to the volatility of the loan. But you really don't have to worry about the fluctuations from the buy and sell demand. And one good example of that is throughout 2008, if you look at a number of the corporate bond indices versus the corporate defaults that they actually received during that time period, a lot of corporate bond defaults were under 10%, yet their indices were down 35-40%. So there was absolutely no reflection or very little reflection to the true underlying value, and they had to deal with the market sentiment pricing. So I think that makes it quite attractive. From a private lending standpoint, what investors really like about it is that you don't have to deal with that fluctuation. Obviously, the flip side is that you don't have a formidable market to trade these in, so you're going to get less liquidity.